Okay. So the other advantage is it allows us to have, specifications of these unique parcels. So location, which really matters. Location, which county are we in? That affects things that affect land values that are location specific. Can be anything from rainfall to taxes to proximity to development, proximity to hunting. If there's really good hunting in that area, that might affect land values. It might also be affected by oil and gas development. There's lots of things that are related to location that will affect land values. Parcel size, and then I put in a term that is the size squared, and what that does is it says, well, okay, as parcel size increases, what does that do to land value? But that also might be an impact that dies out as the land gets really large. Okay. Productivity by soil type, which I already mentioned. Land type, so it's not terribly often that we get a parcel that is 100% one kind of land, that it's 100% pastoral, 100% non-irrigated cropland, or 100% irrigated. A lot of parcels are a combination. It might be 60-40 or 70-30, but just the fact that they are not purely one land type, that matters. So we need to account for that. We need to account for when during the year the sale occurs, because there are some trends. We do tend to see higher land values in the fourth quarter of the year relative to the other quarters, so that matters. Government and program enrollment, so CRP enrollment. Okay, so what kind of results do we get? Let's jump right to it. I'm giving you the state level numbers. I'll show you the CRD numbers in a moment. The extension bulletin that's associated with this presentation has them at the county level. So I would highly encourage you to go take a look at the county level numbers. But just for talking about the overall trends, we're going to focus for now on the state level numbers. This isn't surprising to anybody, but we're seeing that the estimated values of non-irrigated cropland continue to go up. And something that it's not easy to see it in this chart, but the bump from 2013 to 2014 is not as large as the bump that we've seen year to year in previous years, from 2010 through 2013. Those annual jumps up in estimated average values have been going up quite a bit, and now we've seen it starting to taper off just a little bit for non-irrigated land. Okay, irrigated land. Irrigated land from 2010 to 2011, and again from 2011 to 2012, big jumps in land values. From 2012 to 2013, a very modest jump. The numbers are solidly there, and they do tick up, but not very much at all, which was interesting because all the other land types were still going up at a pretty steady pace, and this looked like, well, maybe it was going to level out, but it appears that it was just a slight slowdown in irrigated land that one year, and we've jumped way up again in 2014. So again, irrigated land continues to go up. Pasture land. Pasture land is also going up. Okay, we're seeing essentially this relationship is working a lot the same way that the non-irrigated cropland is working, where you see a slightly smaller jump from 2013 to 2014. But again, it's definitely an upward trend. And at some point, when you're looking at these charts, you have to ask yourself, how much longer is this going to continue to go on? Okay. So the light purple lines, those represent the values that we estimated from the PVD data. So actual sales of land in Kansas, the light purple numbers are the values we estimated. The dark purple numbers are the Kansas Ag Stats USDA numbers based on surveys. And so consistently, the Ag Stats numbers are below our observed prices from the PVD data. Irrigated obviously is the most off I mean, their estimated values for irrigated cropland from USDA for this year were just shy of 3,500 an acre. That's nowhere close to what we're actually seeing in the markets. Where we've got numbers that are being estimated up in the high 5,000s, low 6,000 per acre. And then between, pasture is a little closer, and non-irrigated also has a little bit wider gap. I think the thing to emphasize here is that when we depend on the USDA numbers to tell us what's going on, the trends are pretty comparable to what the market indicates, but the values themselves can be way off, and that becomes a real problem if people are trying to make decisions on land, any variety of decision on land, and they're trying to use those USDA numbers. Okay, here's what I wanted to show you was that if you took those level values and calculated as a percentage change in value, what kind of trends are we seeing here? Let's take the non-irrigated column first. The percentage change in value between 2010 and 2011, 19%. And these are on the estimates coming out of PVD. The 2011 to 2012, 24%. Then we're back down to 19%. And now all of a sudden, the 13 to 14 jump is single digits. It's 6%. And remember, I told you that historically, land value changes year to year, more around 5%. And so all of a sudden, between 13 and 14, the annual appreciation in land is looking a lot more like the historic levels that we're used to, and it's a considerable drop from what we've seen over the last few years. Irrigated, like I said, big jumps for the first couple years, and then just a slight jump up between 12 and 13, but again, back up between 13 and 14, but much lower than the jumps that we saw in the first couple years. I will put a caveat in here for irrigated land. When the data come into PVD, it is noted that it's irrigated land, and it is noted that it has a well, but the depth of that well and how much water they're actually able to get out of it, we don't have very good information on that. To get really good information on that, you would have to go parcel by parcel and look up individual information. So my only concern with our estimates on irrigated is that we're not fully controlling for the variability in well depth and the amount of water that's actually economically feasible to pump. And so we might be a little bit off on some of our estimates. I think we're in the ballpark, but I think it's also possible that if we were to come back and redo these estimates for irrigated, that we might have some slight adjustments there. And then finally with pasture, again, double-digit changes in those first few years, and then just in the most recent change, we're back to a single-digit number of 9%. To be honest with you, the fact that pasture values increased by a higher percentage change than non-irrigated cropland, I think is that 9% increase is being partially supported by the improvements in the cattle markets. So we've seen a decline in commodity prices for our cropland, but the cattle markets are strong, and so we've got what I'd say is a non-typical difference between those two categories. Normally, cropland is going to improve by more than, or appreciate more than pasture land, and that's just a little bit flipped this year. Okay, so what do the values look like across the state? Again, as I mentioned, state level values are interesting when it comes to looking at trends, but we definitely want to take a look at how things vary across the state. Consistently, the northeast corner of the state it has the highest land values. Again, these are average. It has happened. I'm aware of sales that are considerably higher than those averages. But there are also going to be pieces of land that are going to sell for less due to the quality or the location or some external factor. So keep in mind, these are estimates of average quality, average for the 2014 selling year, average for parcel size, and average for that location, the location being that CRD. Okay. As I mentioned previously, if you look at the extension bulletin, you can get these numbers. They're disaggregated to the county level. Same thing with pasture. We have some really good pasture values in the eastern third of the state, and then the western third of the state, pasture land is not worth nearly as much, having pretty much everything to do with the amount of forage available. So how many cattle you're actually going to be able to support on that pasture land, and you can just see that differing across the state. Okay, here's those irrigated land values. Again, I don't have enough irrigated sales to estimate for every CRD. So the central and north central regions don't have values that I can estimate. And if you look at the publication, there will be counties within these western CRDs and the south central that don't have estimates. And that's just because we don't have enough sales in that county to put out a reliable estimate. Okay, I can't talk about land values and the changes that we've seen in them and the slight pullback that we've seen without a quick discussion about rents and net farm income, because this is what we're going to be looking at when it comes to going forward. This is a chart of the North Central Kansas Farm Management Association returns to different crops over a 15-year period. It goes all the way back to 1999, goes through 2013. The 2014 numbers will be coming out within the next few weeks. I expect those 2014 returns over total costs to be lower than they have been over the last few years. But this chart tells us a couple of things. The improvements in net farm income to farming starting in 2007 are pretty highly correlated with the run-up in land values. Okay, so when farming becomes more profitable, farmers have more money to spend on land. And as those land parcels come up for sale, they can be pretty aggressive on bidding on it. Now what happens, though, if net farm income backs off and is not at these high levels that we've seen in the 2007 to 2013 range, which I expect is going to be the case for 2014 and likely going forward. Okay, so these are USDA numbers. Again, they are only giving us, trends, and I don't believe. Well, let's see. I'll take that back. They have a downward dip in cash rents to irrigated land, but all they've shown is a flattening out in non-irrigated versus pasture. That's a little tough for me to reconcile. If anything, I would have thought that the irrigated land would have perhaps leveled out, but you have to keep in mind that in Kansas, most of that irrigated ground is going to go into corn, and corn's probably had the biggest downturn in commodity prices. So it could be that that's why those cash rents are slightly lower for irrigated land. They actually went down in 2014 as opposed to the non-irrigated and irrigated land staying just steady. But this is the problem. If cash rents don't continue to move up, then that's reflecting something about net farm income, and that's going to translate into land values. Okay. The problem with cash rents, again, I'm good at pointing out the problems with survey results because I think about this a lot when it comes to trying to provide reliable information and knowing what kind of information we want to use to make decisions or to do analysis. The problem with the survey results, it's not an opinion or a guess anymore like it was with land values, because they're surveying farmers and they're asking them what they actually pay to rent land. So that's an improvement over the land value surveys. However, there's no controlling for the quality of the land that's being rented. You're just asked to say how much land did you rent, and how much did you pay total for all that land. And so that's their way of coming up with this average value. It completely masks any quality differences in the land that you're renting. It does not consider when those rental rates were last negotiated, which can have, again, a pretty big impact on what the rates are. And it's not going to include any non-market activities. If somebody's renting land from their grandmother and there's some kind of a deal where the grandmother is agreeing to subsidize the person who's renting the land, that's not a pure market-driven cash rent. It's still getting reported in the surveys, but it's not one that's going to be useful for me when somebody calls and says, what is land, what is land renting for? Okay, so what can we do? There's no equivalent to the PVD or some other state agency that records cash rents. That kind of information, does not get collected. So we have to look at other alternatives. One of the things that we can do here is to take a budgeting approach. What that means is we go through a typical production practice based on our farm management farm management budgets, and we can go through and calculate the cost of production for wheat, corn, beans, and milo, and come up with an estimate of the expected returns based on current cost of production and some kind of a yield expectation and some kind of a price expectation. And the advantage to that is that we can make that forward-looking. Instead of backward-looking like the surveys, which ask, what have you been renting land for? We can say, well, what do you expect the returns to be next year? And what would you have to be willing to pay for land to get it based on those returns to farming? This is a good way of getting what I call a marginal rental rate versus an average rental rate. It's the what would things have to be for the next year versus what have they been over the last few years. Once you get that expected returns to farming, you can calculate a crop share revenue, which would be based on a long-term profit expectation, and we're going to apply a risk premium to that. So let me give you just a little bit of detail, and then I'll show you our estimates for 2014, because we've been doing this for about 3 years for non-irrigated cropland and 2 years for irrigated. We use a predicted crop share where we take current inputs and production practices, like I mentioned. What do we use for yield? Well, you don't want to be too optimistic and you don't want to be too pessimistic. So we use a 20-year trend yield. What do you use for prices? So what price are you going to get for your crops in 2015? Well, the best thing that we have to use for an expected cash price would be the futures market. And we come in and adjust that for the local basis to get what an expected cash price at harvest would be. And then we take these expected revenues, adjust them down by 15%, and that's a risk premium. And the risk premium is there because in general, we expect that for a crop share lease, the landowner takes on risk that the crop may not come in or the prices may crash. And so we expect they're going to get more in the long run from that crop share arrangement because of the risk they take on. In a cash lease situation, the landowner gets paid no matter what happens to yields or to prices. And so that's the idea that they would be willing to take a little bit less for the cash rent relative to the long run expected returns to the crop share simply because they're not facing risk. So the 15% is a educated guess on our part. I don't know that that's the risk premium that everyone uses, but it's one that we felt comfortable with based on experience visiting with people. So all of these things can be adjusted if you want to do this yourself, but I'm just telling you these are the assumptions that we made in order to get at something that we could estimate for the 2015 crop year. The biggest difference between the rental rates that we estimated for 2014 and the estimated cash rents that we have for 2015 comes entirely from the drop in crop prices. Nothing else changed significantly. The cost of inputs did not change significantly. It was the expected prices. And for expected prices, like I said, we use futures contracts. So the way I position this is you're going to negotiate a rental rate for 2015, and you're going to do that, in the winter time. So we take the average price of the harvest contracts in November of the preceding year, so it would have been November 2014. What's the average harvest price for futures contracts for all 4 of our commodities? And that's going to be our expected prices. So what you can see here is for the 2014 estimates, that row of expected prices were what we put into the budgeting approach, and then for 2015 I put in prices that were significantly lower. Well, here's what happened. When I estimated cash rents for 2014, those numbers were high. When you estimate them for 2015, they fell off considerably. Again, these are our projections. These aren't actual observed cash rents. This is just what we projected if we had used this budgeting approach and what the futures market prices were telling us this past winter. Huge fall off. What does this mean? Well, this is reflecting the drop in commodity prices. And I'll show you also for irrigated cropland another big drop off. No changes in production costs that were sizable. The 20-year yield means I didn't make a major change in the yields I was expecting. This is being driven entirely by commodity prices. But the first thing I'm going to tell you is, okay, so 2014 might have been the peak for what people were able to pay based on their net farm income. 2015, people might be able to pay quite a bit less if you based it entirely on their expectations for net farm income. But does this mean that we're going to see every farmer drop their cash rents for 2015? No. No, and here's why. We've had several years, I showed you that chart from KFMA, several years of really high net returns, higher than what we expect in a competitive industry in the long run. So anybody who's holding on to cash from those good years is still going to be pretty competitive in that market. They may not be able to bid as much as they could have for 2014, but they're still going to keep things up there. Now, that is going to adjust down, especially if we see commodity prices stay low for the next year or two. Eventually, these markets will adjust. They just don't adjust immediately. Okay. Here's something else that keeps cash rents from adjusting quickly. I can make these predictions and they can change based on futures prices, but that's not what we observe in the state. And a big reason for it is that contract length in Kansas for cash rents averages 3 to 5 years. What that means is that the typical contract is set and those rates are set, and that's what the farmer agrees to pay for anywhere from 3 to 5 years on fixed cash rents. And so a lot of things can change in 3 to 5 years, and then when you get to that point where you know, the contract has expired and it's time to renegotiate, then you have to do it based on what you know at that time. So there's people who are locked in right now to cash rent leases that were negotiated in the last, you know, 1, 2, 3 years, and they're going to be paying prices, or they're going to be paying cash rents that are higher than what we've seen. This chart is from a survey we did this winter of Kansas Farm Management Association members, and what it shows you is that crop share leases, it takes 10 to 11 years for them to renegotiate the terms of a crop share on average, whereas, you know, cash rents get renegotiated, the rate gets renegotiated much more frequently. But we don't tend to have nearly as many annual contracts as other parts of the country. And so that's what is going to keep cash rents from falling off really quickly and really abruptly. Okay, so to wrap it up so that we can get on to folks' questions here, land values are still up for 2014. We did see an uptick, but the rate of growth has slowed for all land types. So we are slowing down, and we are not seeing the double-digit increases in appreciation that we've seen for the last 3, 4, 5 years. That slowdown is corresponding to the 2014 net farm income and expected income for 2015, which are all lower than what they have been for the up through 2013. And that makes sense. That's what we expect. So here's a question. Are we headed for a big drop in land values? Are we headed for the kind of correction that we saw in the 80s, where things were going great, people were bidding up land, and then all of a sudden crop prices fall and, you know, folks can't afford, you know, their mortgage payments? I don't think so. I don't think we're coming to that. A couple of reasons. First is that we're still in a very low interest rate situation. Interest rates are not being pushed up. The Fed keeps threatening to start changing them, and then they keep pushing that back. So interest rates are not going to be jumping anytime soon. That helps. That keeps those mortgages affordable for a longer period of time than it would if we were in a situation like we were in the 80s where we were 15 to 18% interest rates. The other is that, to be honest with you, I think you would need to see a pretty large increase in the supply of land on the market to see the kind of repeat in decline in values that we saw in the 80s. I just had a graduate student present her thesis last week, and she works for American Ag Credit, and one of her supervisors was a credit analyst in the 80s and dealt with these, and he made the point that, you know, the Federal Land Bank chose not to become landowners in the 80s. They did not want to be landlords. So when a piece of property was foreclosed on, it went straight to auction. And that greatly increased the supply of farmland, which is going to put a huge downward pressure on the prices. And we don't have anything like that happening right now. We don't have foreclosures, and we don't have a lot of land going to auction. In fact, we've seen a decline in the number of parcels that are going to auction over the last few years. So these are all reasons why I don't think we're going to see a huge correction in the land values. This is the last chart I will show you. This is just marking on a quarterly basis where the land values have been for non-irrigated land at the state level. And the thing that you notice, like I said, the 2013 to 2014 transition doesn't have that jump up in value that we've seen in previous years. So given this, where are we headed? Are we going to start going back up? Are we going to go down? Or are we going to level out for a while? And this is the extent of the predictions that I'm willing to make. If I had to put money on it, I would say we're going to level out for a while. I'm not anticipating that 2015 is going to see a noticeable drop, but I also don't think that we're going to be seeing the increases that have been characteristic for the last couple of years. I think we're going to be in a steady state for at least another year or so. What happens after that is going to be determined almost entirely by commodity prices, and then if we see any major changes in interest rates over the next year or two, that could change the dynamic. But for the short term, I see things leveling off. Okay, so that's my prediction, and I hope that I hope you guys don't remember it if I end up being wrong. Okay, questions, please. Looks like. Okay, so Brett has a question on anticipating the change in value. How do you anticipate the change in value from a market value in the state as opposed to the current taxable use value? Okay, I think I understand your question. I think you're talking about use value that is used for taxes and how that compares to market value. And the thing about use value for property taxes is that I believe it's an 8-year lagged average, and so what's happening is land values are starting to level off. Cash rents might start to turn back down, so you know the returns to farming are going to start getting a little bit less than they have been, but that 8-year average that's being used for use value is now starting to include all of those really good years. And so people's use valuations are going to just continue to go up. And we might be facing a situation where the actual returns right now, you know, in the year that you're actually in, are going to start going down. And that is simply a function of the way that they calculate that formula, and it's very easy for it to get off. It's been off for the last couple of years where it was including some really poor years in terms of net farm income, but we were at the time having good years, so it was easy to pay your property taxes. Now it might be a little more challenging. Okay, how do numbers change if the landowner owns the pivot? That's a great question. Stu, I have those adjustments to, we're able to do those adjustments when we calculate the cash rents, but I don't have the ability to make those adjustments to the land value numbers because the PVD data does not give me a sufficient amount of information to be able to accurately determine whether or not the pivot is transferring with the sale or if it was owned by the tenant. When I look at cash rents, you know, it'll increase cash rents by, I think it's 10 to 15% if the landowner owns the pivot. They can expect to get a 10 to 15% premium on their cash rents. I'm not going to say that that transfers over immediately to the land values themselves, but yes, the land is going to be worth more if the pivot comes with it, assuming, of course, it's a pivot in good repair and it's on a functional well. Okay. Anybody else have some questions? I will also say, just to fill the time, because I don't like silence, I think it was about a year ago that we started seeing estimates from the Federal Reserve from the Midwest of land values starting to level out, and it's taken nearly a year for that effect to translate into the Great Plains, which is interesting that we would lag in that way, but that does appear to be what has happened. I don't know if that's necessarily the way it always works, but that has been happening in the last year. Okay. Okay, no more questions yet. This information, this is the third year we've put it out. I'm hoping that we'll be able to continue to put it out every year. We've had, like I said, we have a good working relationship with PVD, so that is great. Brett, you have another question. Thanks. Are mineral rights values seeing much of a difference across the state? Okay, that's a good question. For the areas where mineral rights are either being developed or highly likely to be developed, what is happening in terms of the impacts on land values? For the most part, mineral rights can be separated from the surface rights of land, and oftentimes if that mineral right has either been developed or is likely to be developed, the land sales will see those mineral rights get separated, and the previous owners will retain them and the new owners will not get them. And I think that is, while that doesn't happen all the time, we are not seeing in the estimates that we're making based on the agricultural value of the land, we're not seeing it getting skewed in the areas where there's a lot of mineral rights development. So I think that for the most part, the values we have here are reflecting the ag use, its value in terms of agriculture, and not that extra value from mineral rights. We see a bigger changes in land values when somebody manages to take a non-irrigated piece of land and redirect wells and get water on it than we do anything with mineral rights. But I think the reason that that's not impacting it is simply because they're separable from the surface rights. What are current crop share numbers? Okay, Barbara, I will direct you to actually, if you want to send me an email, I can send you to some links for crop share information. Those don't change very much. I think they did increase in some regions a little bit over the last few years simply because of the value of land and the value of returns to land. And it really depends on where you're at in the state. So we have a little bit of information on that I'd be happy to share with you, but I don't have that information right off the top of my head. Okay. I have a question from Stan. It says, we're close to retirement. Would you recommend cash rent or share? That's an interesting question. If this is a pretty sizable portion of your retirement income, it might be a good time to get into a cash rent, because then it becomes a much more consistent return to you on an annual basis, as opposed to crop share numbers, crop share returns, which can be highly variable. So if this is a pretty big part of your retirement, you don't want that to be variable. If it's a small part of your retirement, you can afford to let it be variable, then you might get a little more from it in the long run than you would on a cash rent. That's the way I would look at it, is how big of a proportion of your retirement income is it? And if it's large, then in that case, yes, you might want to look at switching to a cash rent. Now, that's a negotiation you're going to have with your farmer, and there's some considerations there, but just as an across-the-board comment, that's what I would say. What are your thoughts if interest rates start to rise in conjunction with the low commodity prices? From Jerry. Well, I'm not too worried about it yet because these interest rates, if they ever do move, are not moving up quickly. You know, when the Fed talks about raising interest rates, they can't get off of just the idea that they would slightly increase them. So, you know, every time they talk about moving interest rates, the stock market goes nuts. And so they're being very, very cautious, which means that if they do start increasing interest rates, we're going to see a very slow increase. And the only reason to get worried about interest rates going up and commodity prices going down is if we start seeing, you know, a really fast increase in interest rates. I just don't see that happening with the Fed the way they're approaching things right now. Okay, when the cash rent figures on a quarter section with a when the cash rents are figured on a quarter section with a 130-acre pivot, is the cash rent usually figured on 160 acres? It is. That's usually how things are done. It's figured on a full 160, but obviously the value is coming mostly from the 130 acres that are irrigated, and then there's a small contribution to the total net revenue that is coming from the 30 non-irrigated acres. So yeah, you're paying. Typically, people don't split those cash rents out for the irrigated versus non-irrigated. They create one value, but you have to, when you try to figure out what that value is, you have to account for the fact that not all 160 acres are going to get the yield that the 130 irrigated will. Can water rights be severed and reserved by the previous owner? No, not with the ease at which we can sever mineral rights from surface rights. Water rights being severed, I believe it technically can happen, but I think it's a very rare situation and one that requires quite a bit of regulatory hoops. I won't say that it can't be done, but it's not common. Okay, do you know the capitalization rate used by property valuation department to arrive at the appraised value of farm ground? I do not. That's a good question, and I don't know if I can find that. I could probably find that out for you, Dan, but I don't know that off the top of my head. Send me an email and I'll see what I can find out. In southwest Kansas, in a dryland wheat farm where the land is almost universally summer fallowed, are annual cash rents calculated on total acreage or only on 50%? Okay, so again, you can calculate, you can do it either way, but you can calculate the cash rents. Okay, so your question was for the cash rents that we put together. All right, now I'm getting that question. I understand it. Yes, so we account for, in the budgeting process, what the production practices are, and the production practice would include summer fallow, that it would be something that would have, you know, like for Northwest Kansas, we tend to have wheat, corn, summer fallow, and obviously for certain counties, that's more of a wheat fallow or something like that. So yes, we are accounting for the fact that there are that those cash rents apply to a 2-year rotation where one of the years does not have any crop on it. So yeah, we are accounting for that. And what you'll see is, for example, when you look at some of those counties, there's variation across the counties in those, and there's a couple of counties that are quite a bit lower than others, and that tends to be reflecting the standard production practices there. And thank you, Jared. I'm glad I got that answer correct with regard to water. Sometimes I answer questions and I hope I'm getting it right. Okay, any other questions? We're pushing up on the lunch hour, so I suppose a few people are getting ready to head out. Okay, from Shelley, do we know other states do land value surveys? Oh, we know other states do land value surveys. Do you know if other states or universities are there surveys similar to yours? Okay, so this is one of the disadvantages to Ag Stats and USDA cutting back on their survey work and cutting back on the amount of information that they put out. As annoying as it is to do surveys for producers, the advantage to having one group doing it across all the states, and that group being USDA and NASS, is that they do it exactly the same way. Their survey methods are exactly the same and therefore their numbers are comparable. You know, the way they ask the questions, the way they who they survey, and the extent to which they survey different regions, there's a uniformity to it, so that across years those numbers are arrived at the same way. The challenge we have is that when we do a survey here that is done, or anything that we do in the state of Kansas that's done by our university, for example, we don't know that we're doing it the same way as other universities. Probably the differences are not enough to make a huge impact, but you cannot say that they're being collected exactly the same way. Now remember, everything I showed you that's marked as the source being USDA NASS, that would be comparable to other states. Anything that I showed you that was based off of information, you know, from PVD, no, nobody is, other states, as far as I know, are not doing it the same way. Oh, any chance landowners and tenants could get to the point of pooling actual rent contract deals and then sharing it back with the group? A give-get proposition. In my personal experience, no chance in hell. That is just a little too, that's asking a little too much from folks who are, you know, that's their business. There's a lot of information that we, you know, that USDA collects, and some of it's financial information, and they have to take very pained steps to make sure that that's never shared with anybody to where you would be able to trace it back to who it came from. And so you would have to have a very trusted third party that people would be willing to submit that information to. And I'm not saying that doesn't exist, I'm just saying it would, the trust factor there would be really a challenge. So, you know, I learn a lot by going across the state and visiting with people and hearing things. And whenever I do an estimate on cash rents, I kind of look for some people across the state to give me feedback on whether or not they think that's in the ballpark. That's an important part of what we do. It's a very informal process, but it's an important one. Okay, based on your lower expectations for commodity prices, how much would you adjust either a cash lease or crop share arrangement? Okay, Matt, that's a great question. The thing is that it depends on where the most recent cash rent number was at. So if you just did it last year, you'd see a pretty big adjustment down, because I'd say based on you know, we've only got a couple years where we've calculated rents this way, but I think we saw the peak for the 2014 estimates, and 2015 was a pretty big drop-off. If I had 10 years of that data, what we would do is go back and say, okay, well, let's say that you calculated that lease rate, say 5 years ago. So should the 2015 numbers be higher or lower? Well, that's the problem, is that I don't know where that number was 5 years ago for you. So I can't say that those prices should be higher or lower, or by how much, because it totally depends on where they're at right now relative to where they are. And thank you, Barbara. I appreciate that statement. Okay, well, I tell you what, my email's been posted by Rich. We've got a lot of information on Ag Manager. I don't want to keep people from their lunch, and I am more than happy to field emails. That usually works better for me than phone calls, because I'm really horrible about checking my email, or I mean checking my voicemail. So if you can, email is the best way to get a hold of me, and I'll do the best I can to answer any individual questions. And I really appreciate, again, everybody tuning in, and I hope that this was helpful. We will see you again next year at roughly this amount of time to try to give you an update at that point. And in the meantime, just keep checking with Ag Manager, and we've got a lot of other information out there. All right, thank you, folks. Rich, I'm going to go ahead and mute my microphone, if that's all right.